Flint West reporting. Oil spike, rolling shock, and mispriced path. April 2026. Summary statement. Oil is not simply rising. It is repricing a staggered global supply disruption, where markets are correctly sensing the destination but consistently mispricing the volatile, nonlinear path required to get there. Introduction. There is a difference between a rally and a system under strain. Oil has crossed that line. What began as a breakout from a quiet range has transformed into something far more complex, a live repricing of global energy flows under geopolitical stress. Price is no longer just reacting to supply and demand. It is reacting to uncertainty, to timing, and to disruption cascading across regions. And that changes everything. Core Section 1. From breakout to crisis pricing. Oil spent months drifting between $60 and $75, building a base while markets ignored risk. Then came the shift. A breakout above $75 triggered momentum. But what followed was not gradual trend continuation. It was acceleration. Price surged toward $110 and beyond, compressing months of movement into weeks. This was not driven by demand alone. It was driven by a sudden realization. Supply is fragile. Logistics matter. Geopolitics can override equilibrium. At this stage, oil transitioned from a commodity to a risk asset tied to global stability. Section 2. The rolling shock. How disruption actually spreads. The key to understanding this move lies not in the chart, but in the map of global oil flows. Supply disruptions centered around the Persian Gulf, particularly the Strait of Hormuz, do not hit the world all at once. They unfold sequentially. Asia experiences the shock first, Europe follows. The United States adjusts last. This creates a rolling repricing effect where different regions absorb and react to supply constraints at different times. The result, not a single spike, but a series of waves. Each wave reflects a new layer of reality being priced in. Section 3. The market's blind spot, mispricing the path. Markets are good at asking, will oil hit $120? Will it reach $130? But they struggle with a more important question. How will it get there? The current environment exposes this weakness. Instead of a clean trend, oil is moving through sharp rallies, sudden pullbacks, rapid reversals. This is not indecision. It is information flow, in motion. What is being mispriced is not the endpoint. It is the journey itself. Section 4. The chart now. Volatility replaces momentum. At current levels, around $110, the character of the chart has changed. Momentum has slowed. Volatility has increased. Relative strength has cooled from extreme levels. Price action has become choppy. Both buyers and sellers are active. This is a classic transition phase, from momentum-driven breakout to two-sided price discovery. Markets here are no longer chasing direction. They are testing assumptions. 5. Pullbacks are structural, not bearish. In this environment, declines are often misunderstood. A move from $112 down to $100 is not necessarily weakness. It is reset. Key structural zones: 115 to 120, resistance; 105, near-term support; 95 to 100, major reset zone; 80 to 85, foundational structure. Pullbacks into these areas serve a purpose. They release pressure. They rebalance positioning. They prepare the market for the next move. Without them, continuation becomes unstable. Section 6. Expect waves, not lines. The most important shift in thinking is this. Oil is no longer trending. It is oscillating through repricing cycles. A realistic path looks like spike, pullback, spike, consolidation, expansion. Each move reflects new geopolitical developments, evolving supply visibility, shifting market expectations. This is not randomness. It is structure under stress. Conclusion. The first move in oil has already happened. It priced the fear. What comes next is more difficult, and more important, pricing the truth. And that truth will not arrive all at once. It will emerge gradually, unevenly, as supply realities become clearer across regions. This means the market will not move cleanly. It will move in waves. And within those waves lies the opportunity. This content is brought to you by Bobby Gigs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 7. Flint West, Chart Explainer. Look at this. Do not just see it, read it. You have oil sitting up here around $112 after a straight vertical climb from the mid 70s. That is not a trend. That is a repricing event. Now zoom into the right side. You see those moves up, down, up again, sharp drops in between. That is not weakness. That is two-way tension. That is a market trying to figure out if this price is real or just fear stretched too far. Now look at the structure beneath it. That 200-day moving average down at around $70, that is where this whole move came from. Price is miles above it now, stretched, extended, pressurized. And that gap right there, that is what creates instability. Now drop your eyes lower, RSI. You see how it spiked into the high 80s? That was your panic phase. But now it's cooled back into the mid 60s. So momentum's not dead, but it's not clean anymore either. It is transitioning from chasing to questioning. And then look at volume. That surge during the breakout, that was participation. But now it is leveling off, which tells you the easy move is done. Now comes the harder part. This right here, this is where markets decide whether they are about to go higher or whether they need to come back down and reset before they can. So do not ask, is oil bullish? Ask, is this price sustainable? Or is this just the first draft of reality? Because what you're looking at is not the end of the move. It is the moment where the market stops reacting and starts thinking. Flint West signing off.